Welcome to Money Talk. I'm Kim Parley. Thanks so much for joining us. The price of oil has been on a steady climb. It's up about 20% year to date, with about half of those gains coming in just the last month. Some of that is from geopolitical tensions, but are there more fundamental market drivers having oil move higher as well? Bart Melek, head of commodity strategy at TD Securities, has some ideas, and he joins us now. It is lovely to have you here in person.
Well, it's great to be back. Thank you for inviting me.
I will invite you again, I'm sure. Oil always about supply and demand, so I don't know which side of the equation you want to start with right now, but let's start with maybe the supply side. What's happening?
Well, the supply side has been, I think, a very material force in seeing this rally materialize. On the one end, we had Saudi Arabia and OPEC Plus broadly continue to restrict supply. They committed to continue their 2.2 million barrel per day reduction, I'm assuming for the rest of the year. We've seen discipline for the most part. On the geopolitical front, we're seeing tensions between Iran and Israel, not at a boiling point quite yet, but the market is quite fearful that what we could see is an escalation that could at some point potentially lead to disruption in oil flows. We've seen that in the Red Sea through proxies, and this could happen again. So that's another factor. And of course, there is another front on the geopolitical side where we've had Ukrainian drones directly attack refining facilities within Russia, thus reducing supply of distillate that indirectly made it our way, by avoiding sanctions. That means that if distillate supplies continue to be disrupted, I have no idea, but the market is worried. It could mean higher crack spreads and more feed requirements in some parts of the world, which I think has a real potential of causing even tighter markets. And we're expecting deficits for probably the balance of the year.
Yeah, and I guess on that front, and we've heard the U.S. also trying to put some pressure on Saudi Arabia in terms of increasing what their output is right now, because I think they're concerned about these deficits and what it means for them as big consumers.
Well, and of course it's an election year.
Yes.
Washington has never been shy in asking Saudi Arabia to step up production, but it's fair to say that I think Saudi Arabia has very similar a set of incentives as Washington does. They have, easily 2 to 3 million barrels of spare capacity they can put into the market. And I think if we see prices rise anymore, Brent is at around $90, just below today. They don't necessarily want to see crude go much higher than it is. They don't want to destroy long-term demand, and I think more importantly, they do not want to see incentives for shale producers, let's say, to put money in and eat their lunch kind of thing.
They're in a sweet spot right now, right? There's still shale's offline, yeah.
Yes, but today the EIA, Energy Information Agency, upgraded its supply forecast. I don't know if that's directly linked to that 20% increase, but I am quite sure that Saudi Arabia and OPEC Plus are looking at this, and I think there is, from the Saudi perspective, aside from all the expedient market musings that they want to get a higher price, but I think for them there is a sense of fairness. They've, for the most part, made much of the sacrifice. Market share has eroded for them, and they'd like to get it back, and they probably think that they should be the ones that capitalize on it, not anyone else.
Yeah.
So from that perspective, I think they will, at a time of their choosing, probably not Washington's, choose to increase. And let's face it, Washington has suspended the refillment program of the Strategic Petroleum Reserve. So Washington is, I think, concerned, especially in a election year where it never bodes well for party in power to have oil prices skyrocket on them.
Well, let's kind of talk about the demand side then, because every time we see, we're seeing a divergent path with Canada and the U.S. The U.S. just is chugging along, and you're starting to see some real momentum, some steam being gathered.
Well, look, we've had the payroll number last week, and it came out at 300,000 plus. I'm not even sure the market is convinced now we're going to get a soft landing. Maybe we won't get a landing at all.
Yeah, still just maintain flights, dip in flight and back up.
Yeah, I think things are doing pretty well, even with this so-called restrictive monetary policy. There's a fiscal side here that's propping things up. Credit is still available. There's plenty of liquidity. It seems equity markets are on a tear. And yeah, I'm quite confident that economic theory does ultimately work, where higher interest rates will slow things down. The question is, when does that happen? At this point, I think the market is assessing that demand globally will be just fine. Thank you very much. Our forecasts were, criticized sometimes for being too buoyant at 1.2 million barrels, 1.4 million barrels of new demand for this year, but we could certainly be there without any difficulty. And we were quite glad we went long and were optimistic on oil for all the reasons we've talked about previously.
I was just going to say, I've only got about 30 seconds, Bart, but just on that, what are you looking for then prices to be over the next, well, you tell me what your time frame is.
Well, let's go for the next, end of the year. I think for now, we could see prices go above 90. Maybe even triple digits here. I don't think Saudi Arabia is going to be in any sort of hurry. We could very easily see the U.S. Federal Reserve deliver on cuts in the middle of the year, June, July. Possibly that will probably get some speculative money in it, then the carry costs will diminish, and probably demand expectations may go higher, and I'm really worried about Middle East tensions and problems with potential, more destruction of refining facilities, and that's really my only main reason. I think any escalation of tensions and actual bombing of facilities might get us there, and I think at that point Saudi Arabia will probably delay. They'll take the higher prices. They don't think they'll affect them adversely immediately, and will probably inject more supply in.